Gold fell to break above $3,400, but the bullish drivers are still building. So could we see another breakout attempt soon? And what key events this week might set the stage for a bigger move? All that and more in this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Gold prices moved slightly higher last week, but remained range-bound, supported by a cocktail of risk-off drivers, including escalating geopolitical tensions, a weaker dollar, tariff uncertainty, and some concerns over a potential overseas tax squeeze tied to the tax cut bill. This kind of factors boosted safe haven demand and gave gold some tailwinds, though the lack of a fresh catalyst kept bulls cautious. And this week, the spotlight is on US-China tariff negotiations, along with some key US data releases, including the ISM Services PMI and Friday's non-farm payrolls report, both of which could set the tone for gold's next move. And now, on the daily chart, gold against US dollar has been grinding higher over the past week. On Tuesday, prices briefly broke above the 76.4% Fibonacci retracement of the May downturn and flirted with the $3,400 level, forming something of a bullish flag. But just as traders began to price in an upside breakout, sellers stepped in and gold quickly pulled back. Now, prices are testing the $33.62 zone again and trading above the 5-day EMA, suggesting short-term upside potential is still somehow alive. And if bulls manage to push through, the $3,400 handle and the April high near $3,430 will be key resistance level to watch. While on the downside, the 50-day moving average could act as first-line support. Well, I think some traders were likely surprised by gold's sudden surge on Monday. After all, the legal challenge to Trump tariffs hadn't made much market impact, at least not anymore, with many viewing it as just another procedural hiccup. Meanwhile, last week's strong treasury auctions helped bring yields lower and ease fiscal concerns. Given that backdrop, a sideways or slightly lower move in gold would have seemed more logical, but the opposite just happened. Gold rallied. So what changed? Well, in my view, it was the classic double blow. First, the renewed escalation in Russia-Ukraine conflict amplified geopolitical risks, while the US moved to double steel and aluminum tariffs to 50% raised alarm bells over global supply chains, both reigniting safe haven flows into gold. Second, the US dollar took a clear hit that day. Over the past month, the negative correlation between gold and the dollar has been growing stronger. As gold is priced in dollars, any pressure on the greenback tends to boost bullion and vice versa. While prices did pull back the following day, I'd say that was more of a technical breather near key resistance than a reversal. Fundamentally, markets are still swimming in uncertainty. Investors seem to be flip-flopping daily between buy America and sell America, and that kind of indecision is fueling volatility in gold. On the macro front, recent data has been underwhelming. US ISM manufacturing PMI for May fell deeper into contraction territory, April factory orders slumped, and the consumer spending sector in Q1 GDP was revised down from 1.8% to just 1.2%, the slowest pace in nearly 2 years. While the jobs job opening slightly exceeded forecast, weekly jobless claims from last week ticked higher, suggesting cracks are starting to show in the US labor market. That's reinforcing concerns about a slowdown, and markets are now pricing in 2 rate cuts from the Fed this year, a fundamental headwind for the dollar and a positive for gold. On the tariff front, Trump is once again turning up the heat, demanding that countries submit their best offers by Wednesday, with July 8 set as the final deadline for a deal. On top of that, Section 899 of the Big Beautiful Bill proposes an additional tax of up to 20% on foreign entities' earnings profits in the US. The risk of global retaliation is rising, obviously boosting gold's appeal as a hedge, while potential capital outflows, Fed rate cuts, and deteriorating US fiscal credibility could push the dollar closer to long-term valuation levels, such as purchasing power parity. Again, if the dollar remains under pressure, gold may continue to find solid support in the medium to long term. So all in all, gold stayed in a choppy upward trend last week, buoyed by geopolitical tensions, a weaker dollar, and rising trade policy uncertainty. Admittedly, without a true hard landing narrative or a series of nasty data surprises, gold may struggle to explode higher in the near term, but I still favor buying dips from a longer-term perspective. While looking ahead, US-China tariff talks will remain front and center, but with no clear timeline yet, we'll focus on two key data points this week. The first one would be today's ISM Services PMI. While it's expected to tick up to 52 from 51.6, a stronger than expected print could ease fears of a broader slowdown and limit gold's upside. And of course, the main event is Friday's non-farm payrolls. Markets are expecting just 130,000 new jobs added, down from 177,000 last month, with the unemployment rate holding at 4.2%. And if the numbers surprise to the upside, that could revive risk appetite and weigh on gold. But if we see headline job gains below 100,000 or a jump in unemployment, it could signal growing cracks in the labor market, which may start spilling over into consumer spending. That gloomier backdrop could light a fire under gold once again. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!